morning, and welcome to the National Association for Fixed Annuities webcast. I'm Chuck DiVincenzo, President and CEO at NAPA, and this is the 12th webinar series during the COVID-19 crisis, and we hope to bring timely information to our membership and the industry as these unprecedented times transform how we continue to successfully model our businesses. Today, we're pleased to have our premier partners at Nasdaq share with us a microeconomic outlook and insights into the effects of COVID and the upcoming election and on our nation's economy. Our presenters today are Phil Mackintosh, Nasdaq's Chief Economist, and Efram Slen, the Associate VP and Nasdaq's Head of Index Research. Phil has 28 years of experience in the finance industry, including roles on the sell side, buy side, and accounting firms, which included managing trading, research, and risk teams. His is an expertise in index construction and EFT trading, and published extensive research on trading EFT's ad market structure. Efram has helped Nasdaq to launch thousands of index out its offering in the benchmarks, thematic, and smart beta realms. Phil, Efram, thank you so much for joining us today.
Thanks for having us. So I can dive into the macro update. If we can move a couple of slides forward. What I thought I'd talk about today is probably less about the election, because I think that's a long way out considering what we're focused on right now is coronavirus and what it's doing to markets. So let's start with, we'll go through sort of the top down, how the macro environment looks, and then we'll look at sort of the earnings coming through companies and some sector specific information and pricing that's happening in the market, and then talk about the shape of the recovery, because that's really important to market valuations. But before we go too far, there's a couple of slides here from only 2 months ago where we were talking about how good the US market was. We had unemployment at multi-decade lows. We had consumer confidence pretty close to multi-decade highs. And if you looked at the underlying economy, it was really being driven by the service sector and by the consumer confidence. If we move forward to the next slide, you can see that the strength in the economy was actually being driven by some wage increases, and a lot of those wage increases were happening at the non-managerial level. So some really good things happening in the US economy in particular, but even in the global economy, the services sector was driving economic growth across the world, despite a slowdown in trade that had already been happening, and the trade war that wasn't helping that at all. And then if we move to the next slide, we obviously get into what people care about now, because everything changed in a great big hurry. And coronavirus is interesting. It's obviously something we haven't dealt with in our lifetimes, but there are some things that we can draw parallels to before we start to look at the economic impacts, and that's other pandemics in the world. So the Spanish flu, which is the white line in this chart, is the one that I think has a lot of parallels to what is happening now. The Spanish flu actually came in 3 separate waves. You can see that from the increase in deaths, and it ended up affecting about a third of the global population, 500 million people, and resulting in 50 million deaths. Although, remember, it was 100 years ago, and a lot of those deaths were apparently because the hospitalization and the medical services weren't quite as good as they are now. If we compare that to some of the other things that have happened more recently, you can see MERS and SARS down there on the bottom right-hand side. Both were actually kind of similar to what we're dealing with now. They were coronaviruses. They had pretty high death rates as well. So the Spanish flu had a mortality rate of 10%. SARS was very similar, and MERS actually was 20% mortality rates. And that's one reason why people are taking coronavirus so seriously. What's interesting, though, is the SARS and MERS were so deadly that they didn't really get to distribute themselves that much. So the contagiousness of coronavirus is what makes it a little bit more like the Spanish flu, although at the moment, the mortality of coronavirus is obviously much lower. It was running at 2.4% when this chart was done a couple of weeks ago. It really depends country by country how good the hospital system is. If it doesn't get overwhelmed, you tend to see a lower mortality than that. If it does get overwhelmed, you can see 5% and more mortality, but not immaterial mortality, that's for sure. And where we are in the scheme of things is that blue line. So we really are only in early days in terms of how long something like the swine flu took to go through the population and how many people that affected. And although the deaths of the swine flu are already pretty close to equal what we've seen with coronavirus. So if we look at the next slide, now that we've got some context of the different impacts from things that we've seen in the past, you can see that just forward one more slide. Oh, sorry, that's it. You can see that the death rates in caused by coronavirus, which is that red bar on the left-hand chart, clearly show we are above average for normal rates of death. So for anyone that thinks that coronavirus isn't much more than the flu, I think the fact that we are across multiple countries seeing a huge increase in unexpected deaths, it proves that it's a fairly deadly disease. It's at the moment killing more people than heart attacks and cancer separately, but it's the chief cause of death in the US at the moment, and it has been for a couple of weeks. What's interesting, speaking about the US, is their treatment or I guess approach to treating coronavirus as well. So if you look at the US numbers, about a month ago we were seeing 30,000 new cases a day. Right now we're still seeing around 30,000 new cases a day. So it actually looks like we're not having that much success in tackling coronavirus, especially compared to other countries. In Europe, we've got a lot of countries that are 80% down from their peak levels. In Asia, there's obviously a lot of countries that didn't get very big peaks, like Taiwan and Korea, because they had testing and tracking and a lot of mask wearing in their culture. But they've also managed to crush the curve and get down to about 20% of their peak rates or less. But when you look at the US rates, you can actually see a couple of different trends. So the country or the states that have had a significant amount of coronavirus and have had strong lockdowns, like New York and New Jersey, have started to crush the curve, and they've made a big impact on hospitalizations and the stress on the hospital system and the rate of new infection. What we aren't really talking about much in the news is the fact that the rest of the US is actually seeing cases increase still. Chicago right now is actually seeing cases increase. We're not on the exponential curve anymore, but we're definitely not getting this under control. And a lot of the smaller states in the middle of the country are actually seeing rates of coronavirus increasing. So if we move to the next chart, what's interesting about the lockdowns, which is the way to treat or to attack the exponential growth rate of coronavirus, is the lockdowns have a huge impact on economic activity. So if we look at the left-hand chart here, you can see that the lockdown stringency, as it increases, as we move to the right, the impact on real GDP growth goes down. So China down there on the bottom right had very strict lockdown and a huge impact on their GDP in Q1. And you can see there's a linear relationship between how strictly the lockdowns work, with a lot of the European countries down 5-6%, much worse than the US in early Q1 from less strict lockdowns. So you would look at that and think maybe a lockdown is an overreaction, which is kind of contrary to what we just talked about, where the only way to get control of the cases is to look at the states and the cities that have had pretty strict lockdowns and to copy them. And I think one interesting parallel is the chart to the right here is from the 1918 Spanish flu, and it actually showed that the economic impact of states with strict lockdowns was lower than the economic impact of states that were remaining open. So all of those red states had less strict lockdowns. They had higher mortality, which is further to the right on the chart, and they also had less of a pickup in employment when things got better, which is how high they are on the chart. So they're lower down and to the right of the red blobs. So there's an argument for a short, sharp lockdown done really well to shorten the length of time the economy is locked down, which will result in people getting back to work, back to more jobs faster, and actually reduce the economic impact. So now that we've talked about all of those background data points, let's move forward one slide and talk about what's happening in the US. So what we saw when the main states started to go into lockdown was really quickly, in the middle of March, in the space of about a week, over 50% of businesses shut down. That's dramatic. and it was forced upon the businesses. So it's not like the credit crisis where there was bad management and decisions that have moral hazards. A lot of these businesses are doing this for the public good. You can see the hourly employees' hours worked on the right-hand side at exactly that same week. Also fell 50 and ended up being 60 to nearly 70% down. So just a huge reduction in the amount of people working, the amount of businesses open. It's obviously going to have a major impact in the economy. And if we move to the next slide, you can start to see that coming through in the economic data. So what we've seen in even today's announcement with the new unemployment claims, it's estimated the underlying unemployment rate is now over 15%. It's expected to go above 20% before this is all said and done, which puts us well past the realm of credit crisis and other recessions during the last century. It looks a lot more like what happened in the Great Depression. So this is a big deal. The Great Depression was a much more prolonged problem from an economic perspective. To get the economy restarted might not be as hard as in the Great Depression. And it's definitely, looking at the anecdotal evidence, it seems that people aren't applying for work. They're sitting at home hoping that their job losses are temporary, and that when we all restart, they'll go back to their old employers and they'll be rehired and back to normal. So certainly that's what the underlying behavior of the people that are furloughed is showing. But the impact of such a big slowdown on GDP is kind of off the charts. If we look at the right-hand chart, you can see GDP in the US that printed last week was down 4.8% for Q1. But keep in mind, we saw from the previous charts, the slowdown in the US happened in the middle of March. So that 4.8% drop really only counts for 2 weeks of the whole quarter. Since we started Q2, we've stayed in total lockdown. So a lot of the estimates have GDP falling 30 to 40% for Q2. The real question is longer term, what happens in terms of the shape of the recovery, and that's where we'll talk about later what the shape of the recovery is going to be. But first, let's talk about what happened in March and April. If we move to the next slide, one of the things that we saw companies doing, as some companies were laying off workers and shutting down their doors, a lot of companies also went and replenished their balance sheets. So we saw a huge dash for cash. We saw companies pull down revolvers and go to banks to tap their credit facilities. We saw companies cumulatively cancel dividends for at least $70 billion. So that actually created a huge strain on the underlying bond market as well, because banks didn't have that much cash available. So there was periods in the middle of March. You remember the equity market sold off incredibly quickly, but during that period, the bond market sort of froze up a bit. Rates would actually be going up. So bonds were for sale the exact same day that equities are for sale. The classic risk on, risk off trade that we're used to seeing wasn't actually happening. And that's because there was just a lot of people liquidating all sorts of positions, whether that was hedge funds liquidating positions or banks looking for cash to give to their customers. It created a pretty big stress in a very short period of time on markets as well. So if we look at the next slide, you can actually see a little bit about how markets behaved compared to some of the other big sell-offs that we've seen. So 87 and 1929, which is the Depression. It was the fastest bear market we've ever seen. And it got down 30, 40% pretty quickly. It's since recovered incredibly. You can see that with the black line on the left-hand chart. And a lot of metrics looking at valuations, and we'll talk about this in a minute, show that the market might have recovered a little bit too well, at least compared to the earnings and the underlying fundamental data. But the initial sell-off was obviously based on top-down macro views. It was based on some of the things we've just been talking about, where half of the economy is shut down and half of the employees are not working anymore. And during that period, if you look at the right-hand chart here, you can see the VIX in red, which is the expectations of the market volatility, or the fear index as some people call it, went up around about tenfold, peaking at 80. But the realized volatility, the realized 5-day return volatility, actually peaked at over 150. And that's a level we haven't seen since the credit crisis, and then before that, back as far as the wars and Spanish flu era. What's interesting is that's also the period where a lot of the cash drawdowns were happening. and a lot of the treasury market and risk-off trades were uncharacteristically affecting bonds in forcing the bond market prices down, so rates up at the same time. We've since seen in equity markets a big return to normalization, I guess you'd say. You can see the volatility metrics are down towards 30 there. In the last week or so, they've come down even more. So the equity market volumes that spiked actually in February 28 and continued elevated through March are also starting to get back closer to normal. But we've seen days of trading in equity markets close to $1 trillion, where a normal day is 350 billion. We've also seen huge amounts of activity in treasuries and bond markets as well. But throughout all that, we have seen IPOs. We've seen a lot of secondary issues with companies coming to market that need cash to get through this cycle as well. And so the markets have actually functioned. The equity market in particular has stayed up. It's had lit prices and liquidity available to customers throughout. If we move to the next slide, we can start to talk a little bit more granularly about what's going on at a company level. So we're looking at analyst forecasts on the left, and there is a huge amount of uncertainty across the spectrum of analysts. So we've had the market driven primarily by top-down macro sort of data points. We know a lot of people are going to be out of work. We know from a macro perspective, historically, Spanish flu and other events have caused massive GDP falls, and that's how much the market should fall. Now we're starting to see earnings season. We're starting to see companies report. We're starting to see companies comment on what Q2 is going to look like. And what we're seeing is a huge dispersion relative to normal of analyst expectations that rivals the very end of the credit crisis, where some analysts were getting positive on stocks and some analysts were still quite bearish on the survival possibilities of stocks. All that comes, if we look at the right-hand chart, amidst an increasing number of companies that aren't giving guidance when they're doing the Q1 quarterly announcements. So we've got 160 odd companies from the S&P 500 now saying we have not enough confidence to give guidance on what Q2 and Q3, 4 looks like, which doesn't make it easy for us to then work out the shape of the recovery. And I guess it speaks to just how much uncertainty still remains in the market from a company's point of view. And from a macro point of view. So if we look at the next slide, this talks a little bit more about sort of what's driving the market. So we talked before about the bounce back in the market has actually created valuations that are relatively expensive. The chart on the left here shows looking at forward earnings, which have come down more than the prices have gone up. We actually end up with a market that looks richer now than it has at any time back in the last almost 14 years. So clearly the top-down estimates where the market sold off had some pretty low expectations for company earnings. What we've seen though is the market, since we've tackled coronavirus and sort of slowed the exponential growth of cases, has become much more positive about the outlook. And what I see this saying to us is they're pricing in 2021, 2022 as being pretty quick recoveries, pretty close to back to normal earnings. And so the impact from the slowdown right now isn't material enough, even though it's creating this year's forward PE, to devalue the stocks that much. What's interesting looking at the right-hand chart is we have seen buying from the retail segment of the market and actually selling from hedge funds and institutions. And we've actually seen, if you look at Schwab and TD's earnings announcements last week, they've talked about a record level of retail trading coming into their systems. And what we look like we're seeing is a record level of index and retail buying of stocks. So that's part of what's supporting the valuations. If we look at the next slide, we sort of divide the valuation problem down a little bit. You can see that there is still definitely price discovery happening though. So what we're showing here is the market performance in green, and energy, financials, industrials, and materials on the left-hand side are the sectors that have had the worst performance. And if you look at the blue bars, that's their Q1 earnings growth. And those 4 sectors have also had some of the worst earnings shortfalls or reductions. So the market does look like it's roughly priced in sector performance based on what we've already seen the impact of coronavirus on a sector by sector level. within communication services and healthcare and information technology, you can see some winners coming through coronavirus. Obviously, some of the new economy stocks are well positioned. We're doing a webinar right now rather than an in-person conference. So rather than the leisure and hospitality industry servicing us, it's a communication and technology service. A lot of delivery services, obviously groceries and consumer staples are doing better than normal, although some of the other consumer products like clothing are doing quite badly. But you can see dispersion across sectors, and you can actually see the market pricing in the sector returns based on the changes to earnings that we've already seen. If we look at the next slide, you can see that matches up with some of the other data points that are out there. So the left-hand chart is looking at retail sales by category, and just like we talked about, clothing is actually down 50%. So that's one of the biggest hits in terms of what the retail customer has stopped spending on. Also furniture and food and drink services, which is restaurants, autos, and leisure. And none of that really is unexpected. None of us want to go on a holiday if we're going to be sitting next to somebody we don't know who might have coronavirus on a plane or a train, or even in a hotel with air conditioning that we don't trust. And so you can see consumer spending has dropped 25 to more than 30% across those sectors. But we can see food and drink, general merchandise, and health and personal care are winners from the coronavirus so far. And that's obviously filtering through into the stocks and the sector selection that's happening in the portfolios that people run as well. That also marries up with the right-hand chart, which is looking at job losses. And I think one of the important things for us to think about in this chart, just talking about what the shape of the recovery is going to be, is the two biggest job losses are coming from retail and accommodation and food services, so restaurants and tourism. And I think even if we're all told to go back to work, and even if we're all wearing masks, sitting in a restaurant is probably not going to be like normal for a while. Even if restaurants open up, they're probably going to have every second table busy and every other table empty. So they're going to be at half capacity. So those jobs, there's a lot of those jobs, might take a little bit longer to get back online. Entertainment and recreation, probably similar. But as you go down the thread there, you can see some industries like manufacturing and construction, where they might be able to restructure so that they aren't in social proximity and they could get themselves going again much more easily. And so I think looking at the different spectrum of jobs, you realize that restarting the economy is probably going to be a step function, and it's going to be easier for some businesses than it is for others. If we look at the next chart, you can start to see how the market is expecting that will come through in terms of earnings. And so this comes back a little bit to why the market is as strong as it is, considering this year's earnings are so weak. And that is the huge recovery that's expected in 2021 after a pretty dramatic fall off in 2020, whether you're looking at EPS or DPS. So let's talk about getting back to work, because that's what's going to drive the recovery, and it's going to be what determines whether those forecasts are correct or aggressive or too aggressive. So if we move to the next slide, you can see a lot of the states in the middle of America are already open or opening. A lot of them don't actually have such social distancing problems. So the chart on the right-hand side, the blacker that the state is the proximity, the closer proximity that people end up having to work with each other. So you can definitely see a relationship between the states that are opening up or never really closed down and the states that automatically have most of their workers reasonably well socially spaced anyway. What's, I guess, problematic for America is a lot of the red, the orange states on the left-hand side are also some of the states with the highest income and the biggest cities. So it's going to take a little bit of time to get them out of lockdown, and it's going to take a lot longer to get those states running again if they're also on the right-hand side states with social proximity for a lot of the workers. And that just speaks to whether we have a 1 month, 2 month recovery back to 80, 90% capacity, or we actually see a much slower process. So if we move to the next slides, what we can actually do is look at China and how China's experience has fared. China obviously had very strict lockdowns. They got over coronavirus within about a month and a half. They were opening up Wuhan less than 3 months before the early cases. And so the whole of China has been relatively open for quite a while now. What we can see in the left-hand chart is that congestion, traffic congestion in cars is pretty much back to normal. That's the blue line, back to 100%. But subway ridership, which is gray, and rail and air travel, which is the black, is taking a lot longer to pick back up. And I think from that, you can start to see some behavioral characteristics in Chinese that will probably translate to Americans as well. We're already seeing actually in the States a pickup in driving without a pickup in public transport use. And maybe people will get back to work in their cars, which are safer than public transport. And that's what we're seeing in China. Despite the fact that car usage is back to 100%, though, if you look at the chart on the right, you can see, and this is one metric that is just indicative of a lot of other metrics you can see out of China. The intensity of night lights, so how much factories are open at night, is from 50% back to 80% normal levels, but it's still not at 100%. And if we look at the next slide, you can start to see potentially why. So as we've talked about, the chart on the left, this is actually the US's hardest hit industries, but the Chinese chart looks very similar. Air travel, we already talked about, has been hit significantly, and it will probably take longer to pick back up. Movie ticket sales in China have still been banned by the looks of the data. There's still nobody actually going to movies. And the same with restaurants. You can see it's going to be much harder to get lots of people back into restaurants. So there's going to be some segments of the US economy that are going to take longer to get going than others. If we look at the data on the right, though, what we found with China is when everyone went back to the factories, there was an instant pickup in production, only to realize that there was supply chain problems and demand chain problems. So supply chain problems when the factories that they're buying from hadn't got themselves up to speed. The factories that they were buying from actually had illnesses in the staff and couldn't get to 100% capacity. And then the downstream demand chain problems, where even if I can produce the same amount of quantity that I used to produce, there's no one that wants to buy it yet because not everybody is back at work. And so those kinds of hiccups on the demand and supply chain problem are already filtering through Chinese data and making it harder, even for the factories that are ready to go back to 100%, to get back to 100% because the customers aren't there or the suppliers aren't quite there yet. So if we move to the next slide, the second to last slide for me, we start to look at how will the recovery look? What will the shape of the recovery be? And I've picked this chart on the left. This is looking at world merchandise trade, but it's basically showing the kinds of stories that are out there. There are people with optimistic scenarios, which is the green outcome here, which is a downdraft that's short, a recovery that's strong, and we're basically back to normal within maybe Q3, late Q4 this year, which means 2021, it's like nothing ever happened. It's a short period of less income. It's a little bit of a GDP catch-up that we've got to do, but it's not a huge drain on the economy. Compared to the red scenario, which is more pessimistic, where we can't all get back to work as fast as we think, and that means we lose more GDP than we think. It's Q3 before really a lot of people are getting back into the office or getting back into factories. And we, more like we had in the credit crisis, have a permanent downshift in GDP as we recover. Of course, there's a third scenario, which is your doubles W scenario, where we have a second wave of coronavirus. And there's a fair bit of evidence stacking up that that's pretty likely unless we can find a vaccine and get it into production in the hundreds of millions of doses before we get into winter for us again. And that's, if you look at the Spanish flu on the right-hand side here, it's well known that it had 3 waves. The second wave was worse and more deadly than the first wave. Hopefully, if we have or when we have a second wave, we've learned enough about how to isolate specific people, not every person, and keep the economy running at less than 50 or more than 50% as we've done now. In which case, you will sort of see the lows from the W's creeping up, but you'll keep losing production to incremental isolation and slowdowns from waves of new cases. And so that's where people are talking about the V shape, which would be the green sort of a scenario, an L shape, which is more like that red scenario, or a W shape, which is the red where we get another wave and it becomes the purple. The U shape is essentially just a much slower grind into a V, which we've kind of talked about as a possibility too, where the leisure industry does get back up to speed. If we have a vaccination in November or December this year and people can start to get on planes and start to go on holidays again, we could quite realistically see a U shape where it's a 6-month downdraft, but then it is catching back up to normal, where we can all safely get back to doing what we were doing just 2 months ago. So my last slide, I just wanted to put some history back together and talk about, from a big picture, how bad could this be? And what's the real hit to our GDP likely to be? So if you look at the Spanish flu, which we talked about early on in this slide deck, the impact on GDP from that was about 5%. So even if we have a 40% drawdown on GDP in Q2, if we can recover in Q3 and 4, obviously that 40% only counts for a quarter of the year. So the net impact from the slowdown might not be as bad as it looks on the headline numbers. One of the other things that happened with the Spanish flu was the recession. If we look at the right-hand chart, was one of the shortest recessions that we've had in the last 100+ years. And so that would speak, even though they had a second and third wave, to the possibility of a V-shaped recovery, which is what the equity market seems to be pricing in. The valuations are high. The valuations of stocks are saying that the income from stocks is going to be back to normal pretty quickly. The drawdown might be dramatic, but the recovery should get us back on track quickly with no long-lasting recession-like effects where unemployment takes a while to fire back up, and that itself creates a longer-term recession or depression risk. Of course, the thing that's missing is the $4-odd trillion that's been injected into the system this time around. And the government has obviously not held back. It's learned a lot from previous crises. The amount of money that's in the system could potentially be inflationary. That would probably be another reason why stocks would be poised to outperform, at least relative to bonds. But also what's happened is rates at the moment are at such record lows that supports valuations too. So there's a lot of different things going on. We have the record low interest rates, which supports valuations. We have $3 to $4 trillion worth of government support in the system, which could be inflationary, and it could easily plug a 5 to 10% gap in GDP too, which is the other thing. If $3 or $4 trillion adds up pretty much to 15 to 20% of normal GDP. So if we're down 10% on GDP on economic activity, but we've got an injection of that much money, then maybe that will fill the gap in terms of the GDP drawdown as well. Lots of things to think about. We're watching all the data, and I think each week there's new news, whether it's on vaccines and treatment, which will help us get back to work faster, or on employment and workflows and people getting back into the office. But we've got to keep our eye on those things because that's going to help us work out what the shape of the recovery is and whether the equity markets are valuing stocks correctly or not. And with that, I can hand it back to you guys.
Thanks, Phil. Really appreciate that. I got a couple questions for you. One of the questions was the one slide where you showed retail versus institutional. I think I'll get it back to it. Does that concern you at all in terms of how that the retail investor versus the institution, the index and the retail versus the institutional hedge funds?
Yeah, I mean, I think you can see it in the mutual fund flows too. There was a lot of withdrawals from equity funds. There was actually withdrawals for a period from bond funds as well. So that's not helped institutional asset flows. But retail putting money to work, and a lot of those flows probably started when the market had sold off pretty aggressively. So hopefully a lot of those retail people are getting in at good prices and holding for the long term, in which case I think if we look out 5-10 years from now, a retail holder won't necessarily have made a bad trade. And what we're seeing, even if you look at ETFs, which is what retail trade a lot of the time these days, the turnover of a lot of ETFs has gone down significantly. So there's a lot of evidence that shows that retail traders are becoming longer term holders of the ETFs, and they're actually quite long-term investors.
That's yeah. Well, I appreciate that. the other thing is I got a question on the U.S. consumer, because they, that was supposedly, obviously all the information that we hear that they were driving a lot of the growth prior to COVID. How does that? Do you think there'll be a fundamental shift at all?
Good question. And I think that sort of speaks to what shape of a recovery we'll have. Will we all start working from home? Will we want to work from home for longer, even if it's safe to go back to work? Will we do different things for holidays? I think they're all the behavioral changes that we don't quite know yet. But if you think about, Asia has had MERS and SARS in the last decade, and for the most part, they've gone back to normal once both of them were tackled. So I do think like travel and tourism will be back to normal, and spending will be on the same sorts of things that we used to do if we can get a vaccine. And I think that's really important, because if we don't have a vaccine, then for a prolonged period of time, there's much more risk in doing some of the specific activities that put us in contact with lots of people, and with a risk of catching this. The other thing is whether we can find a way to treat this more successfully, short of a vaccine, where the probability of mortality goes down. There's got to be a point where it becomes like the flu, and it's just something that we catch every year. And for the most part, it makes you feel unwell for a couple of weeks, but you'll get over it and life goes on. And if we can get to that point, and that's where some of the treatments like remdesivir are quite promising, because it seems to get people over the hump, and rather than have this for 3 weeks and get quite sick, it seems to help people have it for a shorter period of time and not have it as badly.
That is interesting. I guess time will tell. And the last question before I turn it over to Efram is that, with countries like China, Australia, New Zealand, and Germany, the way they've handled the crisis, really kind of taking care of the health side, will they have a competitive advantage going forward?
That is a really good question, because they're talking about not opening their countries back up. So it's going to be difficult. I mean, tourism is a big factor in their economies, and they're going to say no to that. They also have resource-driven economies, so they'll be able to export the resources, but other people have to demand things like that. So although they'll get people back to work and their internal economy will function better, quicker than ours, from an international perspective, I think the supply chain and the global trade network is actually much more interconnected than we give it credit for.
Thanks so much, Phil. Really appreciate that. So, Efram, I'll turn it over to you for Nasdaq-100 Index.
Thanks so much, Chuck. Thanks, Naf, and thanks, Phil, for a very, very great presentation. Really interesting to hear your thoughts and views on what's going on in the markets and how that translates to indexes, especially like the Nasdaq-100. So here today to talk about that index. We view it as the benchmark of the 21st century. And so when you hear the Nasdaq-100, when you first, again, depending on how familiar you are with the index, I guess I'll first kick off what it is, where it started, when it started, and how that compares to the S&P 500. That's going to be a large part of really what I cover today. So the Nasdaq Composite is the index that most people hear about. When people, every single day they hear, well, the Nasdaq went up, the Nasdaq went down. That's the Nasdaq Composite Index. That's the barometer, the index that includes all stocks that are listed on the Nasdaq stock market. That was launched in 1971 with the launch of our stock exchange. Fast forward 15 years, in 1985, we launched the Nasdaq-100, the largest non-financial 100 companies listed on the Nasdaq stock market. So again, big differentiator there, that this was meant to be, when we came out of this was meant to be the tradable version, again, meant to give you the barometer of really technology, innovators, disruptors, game changers, right? Those are the names that tend to be in the Nasdaq-100 index. Those are the names that really been driving the index for the better part of its history. And so if you look on the right-hand side, they've got a lot of some of the great logos from the companies in the index: Apple, Amazon, Facebook, and so forth. And one of the most important things when you hear about this index is its similarity to the S&P 500 in certain respects, and its difference in others. So and again, that's, again, if we go on to the next slide, kind of talking about performance, and a lot of this actually resonates because of the underlying constituents. So here on the left-hand side, you can see from a performance basis on an annual basis, including through the end of February this year, every year back to 2007, other than 2008 and 2016, the Nasdaq 100 outperformed. So that's very important when you think about how that index can potentially work in an insurance wrapper, where there are buffers to hedge on the downside and ensure that you're only getting upside capture. The other aspect too, if you look on the right-hand side, a cumulative return, bring the Nasdaq 100 to the S&P. So now, thinking about what actually drove these performance differences. So currently, the Nasdaq 100 actually, from a weighting perspective, has about just under 95% of the securities, and the weights rather of the securities that are in the Nasdaq 100 are actually reflected in the S&P 500. Now that starts really at the top. So if you think about those names that I was saying before, Apple, Amazon, Microsoft, Facebook, and Alphabet, those 5 names, those are the largest 5 names in the Nasdaq 100, but they're also the largest 5 names in the S&P 500, and frankly, most barometers that cover the US markets in general. So that is a key component, right, in terms of the similarity. Of course, because the Nasdaq 100 has 1/5 the number of components, it's going to have a higher weight within the Nasdaq 100 index. Of the names that are not in the Nasdaq 100, again, about the 20 names or so, again, a very small weight is actually missing when it comes to that comparison. That's a key point that we like to pointing out is, while the indexes are different, you're getting a higher and outsized exposure to those names that are in the S&P that are really driving the economy. And if you think back from a performance perspective, back on a slide that Phil had shown in his presentation earlier, back on slide 16, we don't have to go into. I can quickly summarize it though, talking about the market performance, and that was just a snippet in time. But we actually have done a lot of research on this historically, and we show from a fundamentals perspective, from a dividend perspective, a lot of the growth is actually coming from those sectors. So it's not just in what's going on right now, it's actually a persistent change, and that's driving the economy, not just with the pandemic and what we're going through today. It's been a consistent trend that technology, that healthcare, and that the consumers are really driving the economy forward. And if you go on the next slide, I have those returns shown in a tabular format. And the most important thing here to look at, there are 2 things. It's number one in the middle column, the correlation, and then the second thing, it's the far 2 columns on the right. It's how similar is the Nasdaq 100 to the S&P 500? That's the correlation of daily returns between those 2 indexes. And almost every year, it's certainly between 0.9 and above, and again, almost every year other than 2017, and in 2007 was right there on the bubble. Many times it's closer to 0.95. And again, that is testament to the fact of the similarity of the names, but the higher exposure you're going to get when you think about the Nasdaq 100. And when you look at the calendar year volatilities, again, not surprising, right? You're getting both on the upside as well as in the volatile times. That, the more volatile times, the Nasdaq 100 is going to have higher vol. And if we go to the next slide, what you'll see there, this is a chart showing the what's commonly heard of as the VIX, in gray, the SIBO S&P 500 volatility index, but there's also an index called on the Nasdaq 100 too, called the SIBO Nasdaq 100 volatility index. So now, very interesting here. Again, in blue, you can see in most instances, the Nasdaq 100 version is actually higher than the S&P. Again, like I said before, not surprising. Fewer names, higher weights, more exposure. So when those moves are happening, you're going to have higher vol. Companies that, even on the mega cap side, that have those outsized weights in the Nasdaq 100 are driving some of that, but so are the smaller names, right? But what's really interesting here, only partially shown, we only have in the financial crisis, but and the most interesting part that I see is in the most volatile times, in the financial crisis, as well as what we were going through in COVID that Phil was pointing out, the Nasdaq 100 volatility has actually been lower than the S&P 500. And some of that has to do with the fact that the returns are less choppy in those times, actually in those specific sectors where the Nasdaq 100 have those sector exposures. So if we kind of fast forward now two more slides into the 100 that make the index, and you can see the weights there. Again, there are two interesting things here, two charts here. On the right-hand side, it's the industry breakdown of the Nasdaq-100 versus S&P. So we've been hearing me talk a lot about technology. That's our highest weight. Comparing it to the S&P, and we have a far outsized weight there. Again, that from a classification perspective. Then we have consumer, and then we have healthcare. Similarly, then you can see, and again, interestingly, is what I was starting to get at before, the 10-year sales growth across those industries from our U.S. large mid-cap benchmark through the end of 2019. Again, we've sliced and diced this type of analysis many different ways. This is the chart we ended up sticking with to show, but you can see here that those sales growth figures really through the roof in those specific industries. And one thing I can't help but I always have to point out, while the Nasdaq 100 chart here on the right specifically is highlighting what our industry classification breakdown is, that's just a sector classification system that we're essentially being pigeonholed into. When we think about our index, we tend to really think about it outside of the classification framework. We tend to think of it as I started off the presentation with, these are the innovators, these are the game changers, these are the companies that are trying to reinvent and reimagine how we're going to live our lives. What are we going to do differently tomorrow? And really interesting with everything going on today. Just recently, Zoom actually was just added to the Nasdaq 100 just about a week ago. So with everything that they've been doing for the world today as a partner to help people, frankly, communicate. I don't know about how many folks listening today, but personally, not just from the work side of things, but just personally, how many Zoom calls I've been doing. It's really been incredible. So again, not a mega cap company by any stretch, but a company certainly that is helping the world and helping our index, moving forward. So and then kind of on the next slide, you can see, thinking about the components in the Nasdaq 100, one of the biggest things that I tend to hear is, really have a lot of high weight in those big names. Is the index even large cap? What are the size? What are the size of those companies? And so that's what drove this chart. And you can see the comparison on an average, median, and minimum basis. The Nasdaq 100 is actually generally larger, right? So that it's actually a real difference. That the story that back 15, 20 years ago, even before, how much the shift has occurred and how similar frankly, again, not just the construct of the indexes, but how much larger our names are as a result of the components that have become eligible. And so if we look through some of those figures, so we specifically say here, the Nasdaq 100 smallest company at 11.8 billion, that's larger than the S&P, and that's really what it's been. We've actually had a larger smallest company for the better part of 11 years, and that's a real big important thing to know when you're thinking about the Nasdaq 100. It is not small cap. It's not even mid cap. It is purely large and mega cap exposure that you're getting. And then I've got one more slide, and then I'm actually handing it back over to Phil to close things out on part of a research piece that he and his team had pulled together. So here you can see, again, what I was touching upon, what are the weights within the 100? That's that first column. Again, very exact same data point we had in a prior slide. But we have contribution to return in the fiscal year 2019, the pure return and benchmark return. What's critical to see here, and again, this is why I think this is helpful with everything we're going on right now, is it wasn't just, it's not just what we're experiencing, that technology from a benchmark return perspective. Again, that's the last column. In 2019, tech had an over 40% return, consumer services at over 22%, and healthcare at over 20%. So these industries are continuing to kind of push and leverage the economy forward. With that, I'll pass it over to Phil to round us out on some research that he and his team pulled together on the Nasdaq 100 recently.
Thanks, Efram. So this just continues on with this kind of theme that Efram was talking about. When you look at the sector exposures and the performance of the sectors, which I talked about, the Nasdaq 100 and the Q index is pretty close to flat year to date, which is about 12% better than a lot of the other large cap indexes. And so we did a deep dive into it, and we looked at what the factors were that were driving those returns. And it turned out that half of the alpha came from sector selection and half of it came from stock selection, which is what the right-hand chart is showing you. So obviously, if you look at the left-hand chart, on the right-hand side of that chart, you can see those sectors we talked about a while ago, materials, financials, energy, that have really struggled through coronavirus, are sectors where the Nasdaq has zero or very close to zero weights. Whether that's a factor of our listings companies tending to be new economy companies, or in the case of financials, the rules of the Nasdaq-100 specifically exclude financials. But that's protected the portfolio, in particular this year, from some of the worst performing sectors. When you look at the better performing sectors on healthcare, we might actually have an underweight in healthcare, but you can see on the right-hand chart, we've had quite a boost from stock selection, which is the orange bar that's poking up there on the left-hand side of the right-hand chart. So when you look at the stocks that are in the Nasdaq-100, because to Efram's point, they're new economy stocks, they're companies like Tesla and Zoom and Netflix, that stock selection, even within sectors, has helped. We have Gilead, the maker of Remdesivir. There's a lot of different stocks in the 100 that are quite interesting stocks given what's going on with coronavirus. So I thought it was super interesting to see that the stock selection gave half of the alpha and the sector selection gave half of the alpha so far year to date.
Thanks so much, Phil. Oh, thank you very much, Phil. And thank you, Efram. That was really great information you shared today, both informative and, again, trying to really kind of enlighten us on what's going on and how we're moving forward. Really appreciate both of you taking your time today for our membership. This webinar was recorded and will be available for those who could not attend today and those wanting to review the content of our website. Our next webcast is scheduled for Tuesday, May 12th. It's Western and Southern's Deborah Miner, who will share insights into generational reach and how to retain heirs and assets. Check out our website for a complete list of our upcoming broadcasts. If you're not a NAPA member and like to support our education and advocacy initiatives in support of the annuity industry, as well as obtain access to our archives, please go to napa.com and click membership and join NAPA. Phil, Efram, thank you again. Thank you all for your time and attendance, and this concludes our webcast.